We are now live on Facebook and Instagram. We have Facebook, we have Instagram. Wednesday, 10 o'clock, 10:05, but is what it is here.
Yeah, we got as close
Beginning
as we can,
of the year. This is our first one.
Yeah, it is.
Well, this is our first series. I think Rachel did one last week. Oh no, Rachel did one last week. But this is our first series of our lenders. So we're involving our lenders, and we're on location today. So we're here at Guaranteed Rate with our buddy Nick here. So he is actually going to take this and run. He's going to go over some things. I'll pop in some comments and questions, and we'll go through this and just kind of talk it all out. If anybody has any questions out there while we're going through, shoot them through or get them to us, and then we can relay this back to Nick. But let's get started here. What are we talking about today?
Really just a 10,000 foot mortgage 101, as we would call it in the college level.
10,000 foot. All right. Fair enough.
Yeah, just that super high level, kind of like
I get what you're saying.
The mortgage 101 of our world.
There's so many people out there that have no idea. You have no idea. You don't even know the beginning questions to ask.
Correct.
So
we really don't. Yeah. So, just to start it off, it's kind of like there's a core four sort of deal. There's really four main mortgage programs, right? You have conventional, you have FHA, you have VA, and then you have USDA. So those are your big four programs, and we'll just kind of break them down individually. So.
Okay, awesome. All right, what's next?
So really just kind of going through them, right? Your top level stuff as far as this goes, conventional wise.
Right.
Some of the guidelines with that, and then we'll break down the guidelines of all the other ones too. So,
awesome. Okay.
Conventional, one of the biggest pieces around conventional loans is that everybody seems to think we need 20% down in order to purchase a house. We don't. We can get something done for as little as 3% down with a conventional loan.
Yeah.
So long as you qualify and meet the parameters that are required for that. But
qualify
meaning there's income limits to that program.
Right.
And that's really the only big thing. That's
Credit
it.
score.
Credit score is 620.
Right.
So as
so
long
you have
as
to
you
have
those two pieces.
Yeah. So if you have a 620, do you qualify for
any of the programs?
Oh.
Yeah. So 620 credit score is the minimum for USDA and a conventional loan program, but 580 is going to be for FHA.
Is that for you guys? Is this specific to Guaranteed Rate?
So that's specific to Guaranteed Rate.
Do other financial institutions have different, right?
Yeah, so everybody's going to have different parameters and guidelines with that piece. I've seen some folks go down to like a 500 on a VA loan.
Oh, wow. Okay.
So there's a lot of give and take. There's a lot of flexibility with regards to that. It's just a matter of the company you're working with, whether it's broker, direct funding bank, that kind of deal. So
interesting. Okay, I gotcha.
Cool. What else you got?
So the 20%, I always think that that's so funny. Like people are like, oh, I have to have 20% down, and you're like, actually, you don't have to have 20% down. You have to have at least 3% down, but 20% down gives you
no mortgage insurance.
No PMI, no mortgage insurance. So it's an extra little added bill that is on your mortgage payment.
Correct.
So it's just a couple $100?
At the most, it's a couple $100,
yeah.
Depending on what you're putting down. Typically, it's going to be between what we would call 0.2% and 0.5% in terms of a private mortgage insurance.
Okay.
So depending on the price of the house, it fluctuates.
Right. So that's how you avoid that. But if you don't have it,
we don't need
immediately, you don't need it.
Yeah,
right.
We don't need that 20% down. You can put 5% down, still get something done with a conventional loan. We can go up to typically like a 50% debt to income ratio, which is pretty stinking high. So we can use half of $5,000 a month to get somebody qualified. Pretty incredible.
Yeah.
And then really just the last piece of the puzzle is getting the appraisal and going through to make sure that the home meets what are like HUD standards.
Okay.
And so Housing and Urban Development has some standard guidelines that your house has to meet when it comes to the appraisal section.
Okay.
And essentially with conventional loans, it's basically just a livable property.
Okay.
As long as it's
doesn't
even have to be like move-in ready.
Right.
Like there can be some paint falling off as long as it's not lead paint, as long as the water, the heat, the electricity is all functioning.
Right.
we're totally fine.
Okay. A heat source.
Yeah,
Not
a heat
necessarily
source.
like, it doesn't have to be
Well, if the
traditional
house,
heat, right?
Correct, but if the house does have an HVAC system,
Right.
it has to be functional.
Okay, for
Yeah,
conventional
for
loan.
conventional
Okay,
loans.
all right, and that's all done through an appraisal. That doesn't
Correct.
have to be done through an inspection necessarily.
Correct.
Okay, okay, that's cool.
Yeah. So,
Next.
Next.
Oh, here we're
What's that?
private.
Yeah, private
We have a little
mortgage
note.
insurance.
Nick has a lot of little notes here that we're going over. So private mortgage insurance, check.
Check. There's options with regards to private mortgage insurance as well,
Okay.
in terms of the fees, how we can set it up, and who pays for it ultimately.
Oh.
Yeah. We're gonna get real fancy on you.
Tricky.
Yeah. So typically, you're gonna see what's called a monthly mortgage insurance premium,
Right.
or like a PMI premium for a month. That's the most common one.
Okay.
With regards to this, that's kind of that typical 0.2 to 0.5
Okay.
range that we're going to see.
Right.
We can also do what's called a split premium, where you would pay a portion of the mortgage insurance up front, and then after the fact, you still have a monthly bill, but you get a discounted monthly bill
Oh, that's kind of
because
cool.
you're giving people,
So you're not putting a full 20% down, but you can put part of your closing costs towards PMI, towards like a chunk of your PMI.
So
Is that what you're
correct,
doing?
yeah.
Okay. So you're paying that at time of closing.
Yeah. So
Okay.
you pay that with your closing costs.
Okay.
And then you can also do what's called a single premium. So that's just as exactly what it sounds like. One payment up front
Yeah.
with regards to your closing costs. Or if you're putting more than 5% down, a lot of times we can build it into your
Okay.
mortgage
Okay.
as well. We can do what's financed private mortgage insurance
Okay.
for a single premium.
Okay,
And it
I
just
getcha.
becomes part of your monthly bill, but you only see one true mortgage.
Sure.
thing.
Okay. So it's like a second loan,
No.
but it's all rolled into one.
It's not even a second loan. It's literally just part of your mortgage now. Yeah.
The things they can do.
It is. It's
Certain-
crazy.
yeah,
So you can do
it's
that,
awesome.
or you can just pay it outright.
Okay.
So it could just be part of your closing costs, or it can be financed.
Okay. I gotcha.
Yeah.
I gotcha. What? Tell me what private mortgage insurance is.
Private mortgage insurance is insurance that covers losses. So it covers the loss for the mortgage company if
Right.
you decide to stop paying on the house.
Right.
So it kind of protects the mortgagee, which is guaranteed rate, or whomever, whatever
Right.
company you're going to close with there,
Right.
with
Fannie
regards
Mac,
to
Fannie
Fannie Mae, Freddie Mac,
Yeah.
anybody like that.
Yeah.
That it's going to protect them when your house goes into foreclosure potentially, that they still get a portion of that money
Right.
back.
So it's insurance. You're paying the insurance for the mortgage company to make sure they're not losing out when the house then ends up selling for less than whatever.
Correct.
So yeah. So that's what people, I don't know, don't quite understand. I didn't understand it until I bought my first house, and I
Yeah.
was like, what? And then I realized what that was.
It's something
Yeah.
that you pay for that benefits the mortgage company the most,
Right.
but it's one of the requirements that
Right.
has
Yeah.
to be
It's
done.
like paying
It's like paying
for like
health
gap
insurance
insurance.
and-
It's
yes.
like gap insurance for vehicles, if people are more familiar with that. So it's kind of like a gap insurance. It's to make sure that if you default or if something happens to the vehicle, that the whoever's lending that money is not actually out that money. So I mean, I think it's still a good. I mean, it's definitely not bad.
Correct.
But if you have 20% down and you put 20% down, the reason it's not required is because the chances of that home not selling for 80% of the value of it,
Yeah,
is
pretty
slim. So that's why
Pretty
they do that.
Correct.
Yep.
So, and then your last option on private mortgage insurance is to have the lender pay it as well. So we would build it into the cost of your interest rate,
Okay.
and then we just take care of that bill.
Oh, no way!
Yeah. So you get a inflated interest rate.
But it's only like,
But you
well, I
don't
mean,
have to
I say
pay,
only, like
yeah.
but when people were getting 3%, that would have made sense.
Yeah, it would have been really fun.
Well, gosh darn it. Listen to this. This is crazy.
Yeah, it is crazy, right? It
That's
really is
that's
crazy.
really crazy. I never knew that. And again, right, so these are, I do want to specify, I know that there are some mortgage brokers that will do this kind of stuff,
Mm-hmm.
but we are speaking specifically with guaranteed rate right now. So this is something like guaranteed rate will do.
Yes.
And these are sometimes specialized programs. So sometimes I've never talked to any other lender that's offered something like this so far. And maybe it's just not something that comes up a whole lot.
It really
so it's
doesn't
not,
come up very often.
Yeah, so it's not
Most of the
something.
time, people are people are very rate sensitive.
Yeah.
So the moment you say, hey, we can
We'll
get you
increase your
this, but we'll
interest
increase
rate.
it up and we'll take care of your private
Right,
mortgage insurance.
right.
Everybody goes, well.
No. Yeah. I get that. I get that.
That's what you see when you're looking at
Sure.
things. You see your interest rate is as low as we can go or whatever it is. And
Yeah.
that's kind of what is the most sensitive piece.
I get that. So again, this is with guaranteed rates. So we just want to make sure that we're caveating that throughout this entire thing. All right.
Correct. Onward. FHA. So Federal Housing Authority is the next loan program that we will cover.
I feel like everybody thinks FHA stands for like first home buyer, blah blah blah, right? So everyone, first
home advocates.
I don't know. I know that every time someone brings up FHA, they're always like, I'm a first time home buyer, so qualify for FHA, not Federal Housing Authority. It's just funny. Anyway.
Yeah. So FHA is not specifically geared towards first time home buyers.
Right.
It can help you out a lot in terms of the upfront costs of getting into a house.
Yeah.
Because of the guidelines and parameters that are required to be met, or some optional things that can be met as well. Right. So biggest one, of course, is your minimum statutory investment, right? Meaning the money that is required from you as the buyer has to be at least 3.5%. So on a $200,000 house, you're talking about $7,000.
Right.
That is what is required from you as someone that wants to purchase the house in order to get into the house. As a down payment. Correct. That is your down payment on an FHA loan.
Let's make sure we say difference between down payment and closing costs.
Correct.
There's a big difference.
So, it can be primary residence only.
Right.
But you can get anything up to a 4-unit with 3.5% down. Right.
But you have to live in one of those units.
Correct.
Yeah.
Primary residence only, have to live in one of the 3 to 4 units.
I know, I'm not connected to the Wi-Fi on my phone. I'm only connected to my stuff. If that happens again, we'll pause here and I'll connect to the Wi-Fi. That's okay.
That's fine. For those 3 to 4 units as well, they do require what's called reserve funds, having money left over in assets in order to be able to have anything just in case you can't get tenants in there fast enough to help you make those payments and things like that.
Okay. Right. So they want to make sure that you have something to pay the mortgage.
Ideally 6 to 12 months.
So what is qualified as is it actually like in a savings account, or can it be like a 401k?
Something that is considered liquid, right? So any liquid assets are checking and savings, 401k, and like your own personal investment accounts. So if you have something in like Vanguard or Webull or Robinhood, something like that, those are tangible net assets that are liquid that you can
just
immediately
spouting off names of random things like Robinhood.
Things that we all know, right?
Yeah, totally.
Things that we all
I got
know.
that.
So 403b, 401k, things like that are liquid that can be tapped into pretty quickly, and used as reserve funds.
Okay.
So, requirements on this: 580 credit score for the FHA loan.
Okay.
Right. That's pretty much as low as we'll go on that one. Max debt to income ratio of 55%. So you can go up to 55% of your monthly income in order to purchase a house with FHA. You do have to have some compensating factors with that, right? So assets in reserves, again, is kind of a big thing. Usually we're going to ask you for a credit score that's not a 580.
Right.
Typically.
Yeah.
And then other things would be like a really good job history. Being at the same job for 12 months or longer. That kind of deal.
Okay.
Yeah.
Okay. That's fair. Totally fair.
We also can ask the seller on this to pay for up to 6% of your closing costs.
Right.
Meaning the seller can contribute 6% of the sales price of the house.
Right.
Towards
closing costs, not down payment.
Correct.
So only your closing costs.
Right. So that minimum statutory investment is your down payment, and then the rest of it can potentially be covered by the sellers. That just depends on a lot of times the taxes and your insurance policy that you're getting as well.
Right. So your oh my gosh, I was going to say something and now I don't remember what it is. I typically write something down. I don't have anything to write down on. So your down payment, no, let's just go on. I'll remember it later.
All right, that's fine.
My brain is not working today. Go ahead. Next.
for FHA, if the house is on anything with regards to like well or septic,
Yeah.
there needs to be tests done to make sure that those are running properly
Right.
and they have the right, like for well, they have the right UV protection.
Okay.
With regards to like cleaning the water.
So prior to listing, if someone gets it done, you'll accept that. Yeah, right.
Yeah, I just haven't. My eyes are geeking out on me for a second.
Your if the seller completes like a pre-listing well or septic inspection,
Correct.
That's fine.
Yeah.
It just has to be something that shows like, hey, by the way.
Yes.
Yeah. Okay.
Yep, exactly. So, all right. So next up is your VA loan.
Yeah. My
Veteran,
first loan I closed, or my first house I closed on was a friend, and she is a veteran out in, and we did it out in Harrisburg. Shout out Brandy. Yeah. So we, we did this. It was interesting. It was interesting. It was nice. It was, I love that they have these programs.
It is.
My dad's a veteran, but we're like, anyway.
It is honestly probably one of the best programs that does exist, especially if you are able to access it with regards to being a vet and having served in the military or National Reserve as well. So 100% financing, meaning 0% down in order to purchase. Now that's just your down payment. You do still have those closing costs, right? So primary residence only.
Right.
Kind of a big factor there.
Can you do the 4 units?
You can.
Okay.
With 100% financing.
Right. Right. Exactly.
Again,
you have to live in it. I have to live in 1 unit, but you can buy up to 4 units. Yep.
Yes,
okay.
correct. There is what is called the VA funding fee on this, and this just depends on. So it's basically VA's version of private mortgage insurance as well. So first use is typically, I want to say it's 2.6% of the loan amount on the property.
Okay.
Second use and every consecutive use after that is 3.3%.
Okay.
It's an upfront fee that gets rolled into your mortgage typically.
Okay.
So.
Interesting. So they just they're like, hey, this is what you're gonna owe us. We'll just put it in here, and then it will just the loan will pay it up front.
Yep.
Interesting.
Exactly.
Okay.
So my favorite part about these programs is honestly that the seller can pay for all the closing costs.
No matter what.
Yeah.
There you go.
Standard wise, it'd be up to 6% is kind of where we're going to cap it.
Right.
But anything over and above, we can do a lot of other things with as far as buying down the interest rate, paying proportions of the funding fee, things like that.
So we are coming back, I feel, after watching and going through some of this, through this market, that we're coming back to people accepting seller assistance. So that's what we're talking about here, is the seller assisting, and the seller in this case, instead of only 6% like FHA, everything.
Yep.
And we're coming back to it, I think, so.
It's not here wholesale.
No.
Right? It's not a full swing in terms of a buyer's market. It's still a negotiation.
It's not like going 100% or do a full 360, but we're seeing more. And again, even in a buyer's market, it's still not going to be not everyone is going to be like, oh yeah, we have the capability, just here, take all the money. It's not going to be in every case, every time, everything, but it is coming back, and that's again what we're slowly but surely.
You get into some competitive situations on a hot commodity that is a specific house, and probably not going to get nearly as much as you want or any.
Right. Exactly.
So
exactly.
Things happen.
Yep.
So back to VA loans. That VA funding fee is there. The seller can pay for a lot of those costs as well. Again, with those minimum standards on the appraisal. So they do have some extra guides with regards to the conditions of the property, what it looks like, and some other certain parameters that have to be met there.
Right.
You do need to get what is called a wood destroying insect report, checking for those termites and.
I think that's just a pest inspection.
It might be called that.
So on the agreement of sale, it's a pest inspection, but we do specify that it is a VA loan. Mm-hmm. So that means that the person doing the pest inspection realizes it's a VA loan and has to do this specific.
Correct.
Yeah. Yep.
So, and then again, with the well water, it has to be tested prior
Yep.
to. And then, of course, that last piece here, in the interest of saving veterans more and more and more money, is there are no lender fees with regards to this, and there are no real estate broker fees.
I knew that. I
So,
did know that.
yeah.
I'm like, my eyes are like, what? No, I knew that. I totally knew that.
Yes.
I'm totally aware of that.
So it saves the veteran a little bit more money in terms of those two fees, which is always a big deal.
Yeah. Yep. That stuff, all of it adds up.
Yeah.
All of it can add up, so that's really great.
Absolutely. All right. So then our last program out of the 4 is USDA. So United States Department of Agriculture.
Nice.
Yes.
Only certain homes qualify for this,
Only
right?
certain
Areas.
qualify. It's
Only
not home
certain-
related.
yeah.
It's specific location based.
Right.
Not Lancaster City,
Nope.
but things like Quarryville,
Yep.
Solanco.
Yep.
Um,
Literally almost
some of,
everything
like,
surrounding.
surrounding areas of like Lidditz.
Yep.
And things like that. Millersville is a big one.
I
as well.
think Lidditz actually qualifies.
Not
Columbia
anymore. They changed
doesn't.
it.
Did they?
Yeah, they changed part of Lidditz.
So I know Columbia
Yeah.
Borough does not qualify. So there's actually a really cool website that you can go to.
There
It's
is.
like a USDA. I literally type it into my Google search. USDA eligibility. If you have access to an MLS search, you can typically it will have like what loans are qualify for that home. If the listing agent is properly looking at where that home is on the map, they'll list USDA as a qualifying mortgage type.
Correct.
Am I saying that right?
Yeah.
Lending opportunity.
Lending option. Loan programs.
I
that
try
are
to sign
available
really,
on this.
really fancy and does not work most of the time.
Yeah, it's okay.
Is it?
It's okay.
All right. What's USDA about?
USDA is always a good option, especially in those what we would call rural areas.
Yes.
Gives you the ability again to put 0% down
Yep.
on the house, right? So 100% financing. Still have those closing costs.
Yep.
Primary residence only,
Yep.
right? Does come with some of the parameters though of a lower debt to income ratio. Meaning like FHA we were able to go up to 55.
Right.
USDA we can only do about 43. Is going to be your maximum debt to income ratio.
I didn't know
So
that.
you lose 12% of
Right.
your buying power essentially.
Sure. Right.
So kind of a big drop, and
Huh.
but for the right people in the right home.
But it's 100%
yeah,
financing.
Correct.
Okay.
Exactly.
So instead of having to have 3% down and 3.5% down.
Yes.
In FHA, you can have 100% financing
Yep.
for USDA, but you do have to have a higher income versus debt every month. Okay.
Yep.
All right. Makes sense.
Again, has to meet
Right.
HUD minimum standards on the appraisal.
Yep.
Well water has to be tested,
Septic has to be
Also.
inspected.
only if it's called for on this.
What?
Yeah. So if there's an issue with it, or like the appraiser goes out and they typically flush the toilet and they'll run the water.
Right.
If there's like a stench coming back to
Or-
them, or water's coming back up the pipes,
Right.
then they're gonna ask you to get the septic tested if it is on septic.
That's kind of nice.
Yeah. So.
Because a lot of those rural areas
are well and septic.
have septic,
Correct.
have septic systems. Old septic. I ran
Yeah.
into a couple of them recently that were very old.
Yeah.
Even like what do I want to say? Like cesspool.
Oh wow.
Yeah.
Okay.
One down on the southern end.
Yeah.
This was a little while ago. But yeah, it was like a legit like
Like,
cesspool. Yeah, it was interesting.
That's fun.
All the toilets flushed though. We did it when we were doing when we were just doing our first showing. Flushed all the toilets. Why not?
Yeah. Why not?
Yeah.
Makes sense. I like it. Continuing on there, up to 6% in sellers concessions, or what we would just call interested party contributions, meaning you can get money from the lender,
Yeah.
you can get money from your realtor, you can get money from the sellers. These
Up
are
to 6% in
all up to
combination.
6% in combination. Correct.
Okay.
So it doesn't just have
Okay.
to all be from the sellers. It can be from the lender as well,
Huh.
in terms of just kind of like lender concessions with some
Okay.
things that we would be able to give out as well, or the realtors on top of that, giving up portions of.
Is that
commissions
different
or
with
things like
FHA
that.
then?
It's the same thing with FHA.
Okay, so it's 6% in
Interested-
combination.
So it's called interested party contributions, right? So
I
being an
had no
interested
idea.
party as the realtor helping them purchase the house or sell the house,
Sure.
you can give up a portion of
Right, commission
commission
or whatever
or
it is.
broker fees or whatever it is. right?
Interesting.
As the lender, I can give up a portion of
what you would make
we
off
would
of
make
it.
off
Yeah.
of it as well, or I can give out like concessions
Sure.
to them as well.
Sure.
And then the seller can do the same thing,
Okay.
right? Giving up seller concessions
Sure.
and that kind of deal. So
I don't want to sit here and say that that's like a common thing that happens.
it's not. It's
Just
the same
because
thing
it's
we
just
talked about with the
right.
FHA stuff. and
Yeah,
the
yeah,
VA,
yeah.
Like where
Yeah.
it is part of the market. It's
Right.
what's happening,
Yep.
but it's all a negotiation.
Yeah.
It's the part of real estate that
Yeah.
is the closing costs are the part that everybody forgets
Yeah.
about.
Right. Okay. Huh. Yeah,
So-
everyone's really concentrated on the down payment
Yep.
and not the closing costs. When a lot of these programs will allow you to have less down payment down.
Yeah. Less money down, but
I'm gonna just
Ability.
let him talk. I'm like, I can't do this right now.
ability
So
to
funny.
get a little bit of help
When it
with-
comes to closing
Correct.
costs versus down payment.
That's
Okay.
exactly right.
Okay.
So, and then of course the last piece that I want to talk about was really just when you start the qualifying process.
Right.
We're going to look at what we would typically call the 4 C's, and sometimes we can throw a fifth one
I
in
was
there,
just gonna say this is 5.
and we can call it the 5 C's. Right? So you have capacity, which is your ability to repay the loan. Right? You have your credit, which is exactly what it sounds like, your credit
Right.
score, your credit history,
Right.
that kind of deal. Your capital. So that's your buying.
Oh, okay.
Your cash on hand, your liquid assets
Okay.
that we covered earlier. The available funds for down payment, your reserves, your
Right.
closing costs, all that kind of deal.
Right.
And then your collateral, which is what is securing the loan. What type of property is it?
Right.
What's the condition of the property and things like that.
Right.
The 5th C that we would throw into there would be what's called characteristics
Huh.
of this, and that's more of like your story as the buyer of the property. So like that's more for the lending side,
Okay.
quite honestly, not so much like the sellers or anything like that. This is more of our job within this world in terms of mortgage is to be able to get you into the house and get you closed, but we have to know your story and how we can work your finances
Right.
to be
Okay.
able to get this done.
That makes sense. I
Yeah.
mean, we as real estate agents also get to know what your character is and what works for you, what doesn't work for you. And that's also how, and sometimes, like, why we pair up with Nick or with some, you know what I mean? Like, why we introduce or why we do the things sometimes. Like, to know who's going to be the best fit for you to get you the best, like some of these things Guaranteed Rate has. I don't know if anybody else is working with some of these things, so it's nice to know
Maybe
that
not.
these tools are at your fingertips.
Yes.
Yeah.
They're all right here. So, do you want me to cover these two?
What is this?
This is
Capa-
just your
oh,
capacity, your usable income types,
I think
your credit history.
the credit I think everyone is kind of really well versed on. Everyone kind of knows what credit looks like. You know, when you go under contract, you don't go out and get a car loan. You don't go out and max out your credit cards and
You don't go buy new
stop
furniture.
paying 40, you know what I mean? You don't do those things, right? You don't
Correct.
buy another house. I don't know. You don't help your daughter buy a house. So that was something I ran into when I was in home equity loan lending stuff.
Yeah.
Was that someone was trying to do something else and they were on like one daughter's mortgage and another daughter's mortgage,
Oh,
and then they
goodness.
were trying to do something, and I was like,
How
you
are we
gotta get
supposed to
off
this done?
those. Yeah, you have to. You can't. As much as we want to help our kids, or as much as we want to help family members or friends or whatever, sometimes it's maybe not the best
It's
idea. Yeah.
It's
Yeah.
tough. Sometimes you got to be selfish about it and
Yeah.
make a decision one way or the other.
Yeah, we have and certain things show up differently on credit, right? So, everyone infamously, American Express how that shows up on your credit really matters. It really matters.
It really does.
You know, so you know, if you're an authorized signer, maybe it's time to not be an authorized signer on that American Express. That's, you know, $10,000.
Mom
strong.
and dad's Amex is not always the greatest thing to be a part of.
No,
Yeah.
it's not. It's really not. So, I mean, any of that advice, though, you know, Nick can answer all those questions.
Mm-hmm.
He's really good at communicating with our people. There's like an app you guys have, right, that you guys are involved with that he can send out to you guys. We actually can send you like a referral through an email. You click on it, you do all these things. It's super cool.
Yeah,
It's
you can do
super
it through
cool.
email and text.
Yeah, yeah.
You guys have your own direct link through that, and
Yep.
gives you the ability to see what's going on and all that kind of
Yeah,
stuff.
so it kind
it's
of
really
walks you
good.
through all that kind of thing. I don't know. The capacity to pay back is a monthly, so that's something else to keep in mind that I've run into a couple times is like your debt to income ratio, which Nick has mentioned a couple times here, is a monthly thing. So it's monthly income versus monthly debts. And your debts are the things that show up on your credit,
Correct.
right? They're not your PPL bill.
Yeah, we're not going to
Or
look at your
UGI.
PP&O. We're not going to look at UGI, your water, your sewer, your cell phone.
I was just gonna
your
say, cell phone
internet,
doesn't. Yeah, that
your
stuff
cable.
doesn't. So that stuff like is your own personal things that you have to
Yeah.
take care of. That's also another thing to kind of realize when you're going into what your monthly payment is going to look like. So
Correct.
just keep in mind all the information that we're giving you. Store it away. Never forget it.
Store it away.
Never forget it.
Store it away, forget it, and then call us.
Yeah, I
Ask us
know,
about
right?
it.
Yeah, ask us
It'll be
anyway.
fine. Yeah.
Yeah, it's not a big deal. It's
how
not a
it
big deal.
works.
That's why he's here. So anything else like high level that you think is really important for new buyers, like people that have been in it for a while? Any sage advice that you can give?
Oh, any sage advice that I can give? I think one of the biggest things to really think about when you're just starting the process or just kind of trying to figure out what you can and can't do with regards to this is to think about your finances and then see where your budget is, right? You may be able to afford to purchase a $400,000 house, but do you want to pay
A
monthly for that $400,000 house?
Right.
Putting that 3.50% down on the property.
Right. Do you know what an average like monthly payment is off the top of your head for a $400,000 house?
About $2,200 a month.
Okay, so right, think about that.
And that's just your principal and interest. That's not even your taxes,
Escrow.
your insurance, anything, and your private mortgage insurance.
Right.
Those three items are still going to be in there.
Right.
So you're probably looking more along the lines of between $28,000 and $3,000 a month,
Right.
just for something in that price range.
Right. So there's so many little bits and pieces of mortgage lending. There's so many bits and pieces of like what gets you from the beginning to the very end, what qualifies you, what doesn't, how these loans work, what your payment looks like. So what Nick just was saying is that your principal and interest payment, and then after that, if you didn't pay 20% down,
Correct.
you have to escrow your taxes and insurance, which means that's a monthly bill that you need to have, which is included in your closing costs. There's there's so many layers to this. I mean, you can go on and on and
There are.
on
Yeah.
and on.
We could be here all day. If we really
Literally
wanted
wanted
to
to be here all day. Want to be
I
here
don't
all
know.
day?
I don't know if you want.
I don't want to be here all day. I'm out. I'm totally out. My brain is just like out. So no, but that's why we have specific mortgage lenders that we go to that we really want to have these kind of breakdowns about. So breakdowns to talk about anyway.
Yeah, we're
So
gonna
the
break it
four,
down with
so the
your partners.
So four loan types, primary types.
Four
Conventional.
primary loan programs. There we go.
Conventional,
Conventional.
FHA, which does not stand for first home buyer
Nope.
programs,
Yeah.
USDA,
Correct.
VA. Okay? So if you want more information about any of these loans, you talk to Nick, you can talk to us.
There
Here we go. Conventional, VA, FHA, USDA. That is a harsh color
It
to
is a
have
harsh color.
on the camera. not in
That's
person,
tough.
just on camera. If you have any questions about any of the things that we talked about, please leave a message. Please let us know what's going on. If you want to talk to Nick, you can reach out directly to him with, do you have a number you want to lay down
Yeah.
right here?
Sure. 717-715-5031.
And then we can be reached, Dahlia Group. It's 717. They're going to kill me. They're going to kill me. It's, I think the last is 3045. Oh my gosh, I'm so sorry. Sam, Rachel, can you maybe leave that down below? I'm really sorry. I know it's like info@thedahliagroup.net
Yeah.
is our email if you want to email us. I know there's like a 7 in there, 3045 777-3045, I think. I'm really, really sorry I'm botching that, guys. Let me know what that is. I should have that written down. So, but anyway, if you have any questions about this stuff, reach out to us. All the Dahlia Group, we're all online. You can reach out to any of us in chats and DMs and text us, shoot us an email, whatever is most comfortable for you guys to communicate. Reach out to Nick if you have any mortgage specific questions. We try to stay in our lanes here, so that's why we have such trusted partners that we work with. So that way, if you have a mortgage question, reach out.
They're gonna point you back to me anyway.
I mean,
With regards
absolutely.
to it, or
Ask
whoever you're going to for mortgage.
I know,
You're
it's
gonna
very,
start asking questions
it's
of
very
your
funny.
realtor, and they're gonna
Maybe
go.
you should ask your mortgage lender. Yeah, it's super funny. We don't, I
We're gonna do
mean,
the same thing.
well, you guys keep up with regulatory stuff when it comes to mortgage lending.
Yep.
We keep up to regulatory stuff when it comes to real estate stuff.
Exactly.
So that's why that all happens.
Yeah.
We can answer the basic questions, and we know we can reach out as well, but to not be a third party, sometimes that works. We're wrapping this up. I don't know who is next week. You're coming back into our series at some point, right? You have
like
another day.
February 8th, I
So-
want to say.
Yeah, so Nick will be back and we'll say in February.
Yeah.
We'll say in February.
Sometime in February.
Next week, I should have looked at that on the calendar before this. But we'll be back again next week with our lender series, going over some more high-level lending information. Reach out with any questions. Let us know how we're doing. All right, guys. We'll see everybody later. Ending on Facebook.